we think that you can buy growth, selective growth, without undue risks the way we do it.
Welcome to Business Ninjas, brought to you by WriteForMe, where you'll hear from business leaders who are out there growing their business and slaying it every day. Learn from the masters. Let's get started.
Hi, and welcome to another episode of Business Ninjas. I'm here today with Richard Hamm, founder and CEO of Bristol Gate Capital Partners. Richard, how are you today?
Fine, and thank you for having us, Andrew, and taking an interest in our company. We're always thrilled that people want to learn more about how they can earn more money next year, so thank you for having me.
My pleasure. Appreciate you spending some time with us on Business Ninjas. Please tell us a bit about yourself and about Bristol Gate.
Unfortunately, I've been in business for like 50 years, so I don't know how to get out. But during my time in the business, I've learned several things that I think have helped a lot of clients, and I've built products of the same general profile along the way. And all that's happened with Bristol Gate, which is now 15 years old in a public realm, not public equities, but in a availability through different types of financial products, is that if I put the lesson in place that I learned in 1970, in the mid 70s, then I'd be a lot better off than I am today. And I didn't really do much. So back then I was told by an old World War I stockbroker, of which people forget there was no money, right? There were no financial resources. Nobody held stocks. Pension funds didn't hold stocks. But what he showed me in his little moleskin book one day was, he said, "You see these stocks?" Because I had asked him, "You don't seem to be applying a lot of financial theory to what you're doing." He said, No. Here, son, here's what I do. And he showed me his moleskin book. And he said, "You see these names?" I said, "Yeah." He said, "They all pay a dividend higher than the cost base of the shares. That is how you make money in the stock market." And he said, "But you probably will, go work with the new young people downstairs, and you'll be looking for stocks that go from, 10 to 20. All of mine do." And so, of course, he was right. And it wasn't until about 1985, when I went into the mutual fund business and left the brokerage business, that I remembered what Mr. Weaver had told me. And I said, "Okay, I'm going to build this product." And we called it the income growth product. And the premise was no different really than it is today. Identify companies that can grow their dividends next year. And obviously back then there was no technology. So you were doing a lot of this stuff by hand and reading on annual reports and summary financial postcards, etc., to get the names of the securities. And it became apparent to me that it was a tremendously strong performing fund. And we had it kind of set up as 70-30 in the balance category, with the bond components being higher yielding corporates. So it was a combination, but eventually we moved into, and then I went into real estate, and we applied exactly the same capital allocation thinking, because real estate is not complicated if you allocate capital well. It's very complicated when you end up in a situation that's incorrectly leveraged or works against you in some way. But if you've got income and properties, these were income properties, and you sort of based your life around how much income could you produce and at what price that income was available, you end up producing more distribution, or more cash for distribution than the cost base of your shares. So that's what we did in real estate. And then I got brought back into the business by one of Canada's big banks, who were struggling with their wealth management, and came to me and said, "Would you mind sort of talking to us about it?" And at the end of the day, after visiting their branches, I mean, this is sort of 2006, visiting their branches, talking to their people, and finding out that the general bank people were scared to death to recommend financial products, and they'd send them to the brokerage firms. And I said, in your branch, you've got all the flow in the world of people and nothing to offer them. I said, build this product. And they said, okay, go ahead and build the product. So that's how I got back into business. I wasn't intentional, but I'm glad I did, because we've managed to build the product in a much better way than we would have done in 1985. And the biggest differentiator, Andrew, is quite simple. We embraced data. I've embraced data my whole career, everything I've ever done. But we really embraced data when we started this by applying simple multi-linear regression models to the data that was available, and data was getting better all the time, and made predictive analysis a big part of what we do. And we would estimate not what the dividends were going to be in the next quarter, we estimated a year ahead. And by doing that, and then using fundamental analysis to confirm that the companies that showed up were good, we would build a portfolio. And it was like, it was actually shocking to me and to a lot of other people when I would ask, what do you think dividend growth is like in the United States? Now, remember, we knew it was a good place to be, and it's always been a good place to be, but the verifiable evidence of how good it was not available until computers and data became better. And they would say, oh, 8% would be pretty good. And I said, no, it's unbelievable. We have lots of companies that are over 15% dividend growth. And they were basically shocked, as were we in a way, because you'd say, that's an awfully big dividend increase. You quickly found that those numbers were, for the most part, between 13 and 15% for years and years. There was always a group of securities in this high dividend growth category, and most people skipped over it. And the reason they skipped over it is because, and we made a mistake. We called it the dividend growth fund at the beginning. And of course, the dividend yield was like 1.5%. And so everyone said, where are the dividends? It was not the smartest thing we ever did. So we changed it to the U.S. equity fund, because primarily what we find is we identify growth companies that have hit a different level of maturity in their business cycle. So you're not speculating on them, or you're not hoping they're going to do well. And that's a strategy that people employ, but not us. We have to have companies with a history in it, because you can't predict if you don't have a history to begin with. And all we've done is move from that multi-linear regression approach to applied intelligence. Like, artificial intelligence is a crazy name. It's not artificial at all. It's just applied mathematics. And you can do things that you could never do with 1,000 people. And, it's, to me, I hear it now. I see it now. It's the big popular thing for people to say, if it's not in your DNA, these are just add-ons. It's like saying, oh, I'm an ESG guy. And, maybe you are, maybe you're not. But if you're just, ESG greenwashing, you wonder. And we recently had a visit with the SEC, which was quite interesting. They came and saw us because they're on the path of trying to figure out who's AI washing. And which I think is admirable. But the fact is, I know lots of my competitors don't even know what it means.
AI is simply a tool, right? It still has to be implemented with human intelligence, or it is just a bunch of numbers and data that might look nice on a spreadsheet, but how legitimate is it at that point?
It scares people because they look at it as a job dissolving process, right? And what you got to do is you got to embrace it as the job augmentation process, because we now do data science at a level that I think is untouchable from anybody around the world in our particular focused space. And these smart PhDs who are out grinding out different numbers, looking for different patterns, looking for different answers to different questions. They have to ask those questions. The machines don't really ask those questions, although that's up in the air now with ChatGPT. I mean, you could probably train ChatGPT to ask 1,000 questions and run it through the data, and you're going to find an answer, which may be okay. But in the meantime, I just think that it's a business of trying to manage a business without thousands of people being analysts, which would be required 10 years ago. You'd have all these people trying to work out the math, and then how would they coordinate it? And how would it become correlated as useful information? I believe it's going to be more common. I believe that people are going to start buying it. And then we have the double-edged sword of trying to get that point proven to people. And, they all love the fact that we can generate portfolios that over 15 years, the dividend growth numbers have been like 19% a year. That isn't your capital return number, but that's your dividend growth portfolio number. And when you change things around, you have different types of slippage and stuff, but still your yield on cost, which is the business we're in, they go up dramatically. So not only does your capital go up, so you're buying growth, progressive growth. You're not buying growth with no boundaries. You're buying growth that's actually quite managed with evidence about their ability to grow. And then after they make their capital allocation decisions, have excess capital in the form of raising their dividends. And, dividends, we love dividends for a simple reason. I think the facts are something like, if you don't own a dividend stock over time, and you own another, just a non-dividend stock, your odds of success are 1/2. So in other words, you have a 2-to-1 advantage investing in dividends over the rest of the market. And you go, well, today people would say I'm crazy, because they'd say, oh, what about all those FANGs and stuff? And totally different kind of world, right? Totally different thing when you have, 7 stocks, maybe 8 sometimes 5, that have produced half of the return. This year, half of the return year to date is from those stocks of the S&P 500 index. So you're not buying an index, you're buying a really crazy thing called the S&P 500, which is so distorted by 7 names. Every time people buy passively, they add to that contradiction in terms of a balanced index or a well-rounded index, and it keeps getting weighted. And so the risk goes up. It doesn't go down. Of these stocks getting driven up to levels that maybe are not sustainable. Maybe they are. I mean, technology is always going to be with us. It's always going to be a part of a fundamental part of the market that is not valued for dividends. But we're quite happy just participating in our little space. And over the 15 years, we've kept up or slightly ahead of the S&P 500. That's not an easy thing to do, right? So this year, the market's up 15%. Take out those 7 stocks, it's up 7%. It's a big difference.
I applaud your approach. I mean, in terms of someone wanting to listen to what you have to say, you've got 50 years experience doing this in the manual analytical way, but you're embracing technology and moving forward. And I think the combination of the two, it's fairly obvious why you've had a pattern of success that's this long.
I think the thing that is most intriguing to me, why I love coming to work really, is these younger people who are far better trained than I've ever been in my life. They love the searching. It's like searching for treasure, right? You're not quite on the high seas with a patch over one eye, but you are in fact letting these people go. Like, I don't restrain them. Nobody should be restraining these people. They should be investigating. Curiosity is a key part of investment management. And so data science actually exponentially changes curiosity, because you can now get answers to your curiosities a lot faster. we had a firm, this is an aside, but this is interesting. We had a firm that was going through due diligence with us. And one of their checklist rules, they always have these checklist rules, was, you don't have 25 people. I said, we can have 80 people tomorrow if I fire a data scientist. And I said, I can assure you we'd have 80 people, but we'd be way less effective. And they went, oh, I see. Yes, good answer. But,
Hey, perception is important, right? Especially in the land of investment.
It is. And so we actually fight a lot of those checklists ideas. But to me, this is an engineered, process-driven investment strategy. And that doesn't mean it's a pure quantitative black box model. There's nothing black box about it. It's like a glass door model. You can look right through. You can figure out the code. People can look at the code and they can figure out what you do, or they shouldn't. I mean, if they're trained that way, they can figure it out. So there's nothing magical about it. It's just we built and customized the algorithms to suit what we know we can investigate and what we can train the machine to learn. And it's iterative. It doesn't stop.
Again, there is no limit to what can be done moving forward. Again,
Right.
it's a tool. If it's applied properly, the sky's the limit.
Yeah.
Tell me a little bit about your clients. Who are your clients? Who are you serving?
We are think of ourselves more or less as like a product manufacturer. So we build these products, this growth product, digging a growth product, and we sell to accounts of banks, to accounts of big wirehouses where they have SMAs, the segregated management account systems. So we would deliver models to them and they take what we do. And then we would deal with them. We deal with a mutual fund company. And so we're a sub-advisor in the mutual funds. And then we deal with a lot of family offices who invest either directly or in limited partnerships that we have, or they have custodial arrangements and we manage the portfolios at the custodial level. So we're not in the wealth business. We're an advocate for the wealth business by thinking that if we can provide a product that's good for their clients, we're helping. That's the way we sort of look at it. And people say, oh, what should I do with my money? I say, I don't know. I don't. I mean, I'm not in the asset allocation or the wealth asset allocation business. That's why you have advisors. That's their skill set. It's not ours. Although we do some work, kind of for fun around the world of asset allocation, figuring out if we can automate any of it and help the advisors with our answers. We don't have any great answers yet. So
I'm going to say you are humbly selling yourself short. If the dividend numbers you're over time or what they are, you are in the wealth business. You're helping people grow their financial future. So I think you are selling yourself a little short.
We are, but it's the wealth business is a direct client business, right? Whereas our direct clients are generally large firms that have lots of advisors. So if we can get lots of their advisors to use their clients, then lots of their clients benefit. That's the way we look at it. And so the leverage of being in that business is positive from our point of view if we're doing a good job, because their clients are going to have more money. And it's very simple. We wake up every day thinking about how can we make clients more money next year. And I've never met anybody, by the way, who said, don't do that for me. I don't want to do that.
Can I please take a loss next year? I need it on my taxes. No, not a conversation you hear very often.
Not very often, no, not
What,
at all.
aside from your wealth of experience and knowledge and your embracing technology to move forward, what is the biggest differentiator at Bristol Gate? What makes you stand out from the competition?
Well, we hunt in an area that nobody really pays attention to. Dividends have lots of different facets. And so most people would overlook us because they have a higher yield threshold. And most dividend funds, by the way, they're looking for higher yield levels, 4 or 5%. I mean, when rates were zero, high yield dividend stocks were terrific, right? People were able to get more than they ever get in a bond or in a term deposit. So we would not be as popular in those moments in time because we weren't paying out that much money. We think that you can buy growth, selective growth, without undue risks the way we do it. Because these are companies that are growing. These are not companies that are big companies paying the same dividend year over year. We try and get out of the volatility of parts of the market and tend not to be involved with commodity-based companies. You can't predict commodity-based companies for the obvious reason that rarely do you have a chance where you can say, oh, copper is going to the moon. I mean, yes, there have been a lot of people say that, but it doesn't happen with great regularity. So, and financial companies tend to have a lot of interest rate risk, and that is unpredictable as well, or not as predictable. And so we don't get into macro forecasting because we don't really believe as anything to do with how business operates at the micro level. The factors of the macro are going to impact it. And any issue that is out there in the bigger world, from supply chain to rates to whatever, are going to affect those companies. But we like to figure out how they will be affected by these changes. And when you teach a machine to look for things, they sort that out. You know, you go through long periods of time in testing these things and back testing for that, and make sure that you've got what you need for the company that you're going to buy, and how to monitor it, and how to predict the dividend and the next dividend, and the persistence factors of these companies. This is the differentiator. People do not get into the names of the companies that we look at in the same way at all, because we want to know as much about them from how accurate can we be a year forward, how good are we at adding companies, kicking out companies, and adding companies at the end of that year with a better company. Some companies just appear to be great and aren't. You know, we've done a lot of work on long predictions where we can predict almost 3 years. And you see serious price return differentiation in timeframes. And so for us, it's capturing the persistence over time and figuring out, should you hang on to these companies? People believe that the best way to make money, and they're right, is long-term compounders. They don't exist. All the academic research in the world will tell you it is a fool's errand thinking that you're going to find them. They're a very, very small set of securities in the market. Often they don't participate in our markets because they've already done their bit. You know, I mean, the Microsofts of this world, which we own, but the point is, we didn't know it when it was dirt cheap, when all the compounding really impacted it. We do fine because they're paying higher dividends and growing their business. So it's a different part of the market. We just don't like to introduce ourselves to unnecessary risks that can't be in some way quantified and evidence driven. I'm not right all the time. I mean, evidence, that's not what happens, but you do your very best to make sure you've taken as much of the unknown out of your equation and come up with things. And I think we're 60% better than Wall Street at predicting dividends. That's pretty significant.
That's pretty significant indeed. Well, it sounds like your approach is slow and steady wins the race. I'm going to say that younger people are looking for fast dollars and high risk, high reward type of situations. And you know the statistics about those sorts of endeavors.
Yeah, see, we're perfectly situated for babies and old people like me. I mean, because the babies don't know any better, and they'll be better off. And then we know it better, and hopefully we'll be better off. But, you know, growing income it tends to ebb and flow, but it's becoming more and more important, I think, to people's overall asset selection process. Because what are you going to do? Where are you going to go find income? Like, general real incomes are going down, right? The middle class doesn't exist. How people are going to retire without products that can provide more income, I don't know.
You know, incomes seem to be static, but the cost of living certainly isn't. So
Yeah, if you take the sort of the GDP and you take inflation and then you take the actual growth of employment income, it's negative. You take the government out of the GDP, it's very negative. So nobody's getting a hit, and nobody's giving you a raise that's at the level it should be at, right?
All right, this is going to get distasteful quickly if we go down that path. So let's switch gears a little bit. Tell me about growing your business. What role has content played in the growth of Bristol Gate Capital Partners?
Well, I'd like to say that it's had an impact, but getting through to people, as you well know, has narrowed from when we started. People probably were willing to give us 30 seconds to a minute to now like a microsecond. And it is hard to get people. I only need about a minute with a person to really describe why this is a good idea for them to look at. Not to do it right away. They should do some work, which they do. But to get a minute is a fight for hours. I can't get over the unopened rates. It just is, I don't know. And people tell me on the road, we don't tend to have a lot of people out selling on the highway system. Since COVID, offices have changed dramatically in their reception to having people like us come in and talk to their advisors in the branch. And understandably, they some of them just don't want it. But then the makeup of those offices has changed dramatically, where attendance is very scattered. You don't know if anyone's there or not there. And a friend of mine was just in a big office in California, and they had 17 people on a floor that would hold 1,000. So he's like, "Where's everybody?" And well, they're not in the office. So content, obviously, good content, and trying to be more consistent with content, trying to get people not depressed about the fact that nobody wants to talk to them is a big part of your daily grind. But as I say to people, people often respond on the 7th to 10th time. And see, when I was using data in a slightly different way in direct marketing, you would often find people would respond to the 4th or 5th direct marketing card that you sent out. And we would keep track of all this stuff. And then we would go back to the people and say, we sent 5, you sent number 1, you sent number 3. And they would say, oh, they were on my fridge or whatever. But at least they paid attention then. Now, people, they don't do it. I don't know what's happening.
I think people we're inundated. I mean,
yes.
I now get so many spammy texts a day. It's not just phone calls and emails. It's a 360 assault. So people sort of numb out. I guess it means that we have to be more efficient in messaging, right? There has to be flypaper right out of the gate. There has to be something engaging right away. There has to be value at the very first touch. Otherwise, there's just too much information coming at people to bother. And, it's a short attention span, immediate gratification generation. I mean, I know that's a broad stroke, but, our email boxes are overflowing every single day. So how does a message cut through to you to actually be heard? There's definitely a skill in that.
And there are a lot of really bad skills that are being applied, where I get something from Bill at 9:06, and at 9:07 I get something from Andrea asking if I got Bill's email. I feel like emailing back and say, Andrea, what do you call Bill directly?
All right, look down the road a year from now. What are some things you'd like to be celebrating personally and professionally?
Well, personally, I'm kind of happy. So I'm past the age of great celebration. I'm just thrilled that family and everybody's healthy and all that stuff is all good. But in terms of the business, it's always a struggle to grow a business, more than anybody believes, I think. And as I've said, getting through to people is difficult. But for us, if we're successful with a couple of the big accounts that we are lucky enough to go through due diligence and be accepted on, we will be so busy, we'll be delighted, right? We'll be having fun again. And that's the most important thing, is that when you're not busy, it's not fun. And when people keep saying, even though you have an unlimited number of opportunities, when there's no receptivity, it's not fun. And so even a little bit of receptivity makes people joyful. So if they're happy, I'm happy. It's kind of not that complicated.
It's a great answer. And I hear you loud and clear. Please tell us, where can people find Bristol Gate Capital Partners? What's your URL, and what social media outlets are you using these days as well?
So we're located in Toronto, which confuses quite a few people, because they say, what are you doing in U.S. equities in Toronto? And we kind of always have had the belief that looking from the outside in is sometimes a much simpler way to run a process, and not be inundated with noise in any other way. But in the noise category, our URL is www.bristolgate.com. So most success we've had probably in telling people about our message has been LinkedIn. We actually apply artificial intelligence to our sales management processes as well. So we have a pretty good handle on when Andrew opens his email, and you know, when, if ever, does Andrew pick up the phone? And so we use that. We have done the traditional Google. We have not done anything on YouTube. People keep saying we should do something on YouTube. We do blogs. Cadence for us is important, but high cadence probably is not what we do. It's sort of more slow and steady, and that's probably not the way to wake people up, as we have discussed. But you know, I think that that's about it. You know, it's interesting to me. I used to spend a lot of money on advertising, traditional advertising, and now I can't understand why anybody spends money on traditional advertising, other than, if you know, the old rule: if the prospect drives past that sign every day, you better put a billboard there. Besides that, it's very hard to know what results you get out of advertising. I talk to people in the advertising business, and there's nothing substantial that would change my mind at this stage. So if you can get to the right people, and we've done nothing with influencers, although there have to be financial influencers out there that are worth pursuing. We've done nothing groundbreaking in how to get to people. Long and the short of it is, we have looked at the opportunity set of how you communicate, and we think we've covered the majority of them, but probably not as effectively as we might.
Understood. Richard Hamm of Bristol Gate Capital Partners, thank you so much for spending some time with me today on Business Ninjas. It's been a pleasure. All the best to you and yours, and continued success at Bristol Gate.
Thank you, Andrew, and all the best to you too.
Thank you so much.